The first of the three analysis tools we'll be discussing is the price-earnings ratio, otherwise known as the PER. This is used for valuing a company and it measures its current share price relative to its earnings per share. This value is compared to the company's PER history as well as industry averages. Generally, a high PER indicates that the investors expect higher returns in the future because they're paying so much. It's used so that businesses can determine their future outlook and growth opportunities, and with this ratio, investors are able to determine how much they pay per $1 of earnings. To calculate the PER, we need to do it in two steps. Step 1 is to calculate the EPS by using this formula, and step 2 is to take the current market value of the shares and divide that by the EPS. In our example, Rogers has an EPS of 80 cents as of 2018, and their current market value per share is $60.58. If we divide the share price by the EPS, then we get a PER of $75.72, which is a good sign for Rogers when comparing with their history and rival companies.
Another useful tool for investors is to determine the current dividends paid out. This is called the dividend yield, and it's a ratio that measures the amount of cash paid out relative to the market value per share. The formula to calculate it is expressed by dividing the annual dividend per share by the current market value price of the shares, then multiplied by 100 to express it as a percentage. Much like any other ratio, dividend yields are meaningless unless they are compared to yield history or the yields of similar companies. The higher the yield, the better it is because it means the company is paying a higher share of its profits in the form of dividends. The business can use this to measure their own stability in terms of share price. The investors can know how much cash flow they're getting based on every dollar of their investment. These ideas are proven in the company Rogers. The annual dividend per share of 48 cents is divided by their stock price, the same as before, $60.58. This gives them a yield of 0.79%. Compared to other companies, this is a low yield and could deter potential future investors. Finally, the last analysis tool that we will be discussing is return on equity. This shows the dollars earned for each dollar invested by the shareholders. The ratio uses the profit of a business divided by the average shareholder's equity, multiplied by 100 to express it as a percentage. The result can again be compared with the ROE history and industry averages. A higher ROE would mean that the business's operations are more effective in making use of the investments. It allows investors to decide if they should invest in the business and helps the business improve their own operations. For example, Rogers' shareholder equity for the beginning of 2017 was $6.3 billion, and at the end of the year it was $7.5 billion. The net income for the period was $1.7 billion. To calculate ROE, step 1 is to calculate average shareholders' equity by adding the two values up, then dividing by 2. Next, we take the profit of the company and divide by our average, and then multiply by 100%, giving us an ROE of 24.6%. This means that for every dollar of shareholders' equity, Rogers earned about 25 cents in profit. In essence, their net income is very high in relevance to the amount of share capital.